You open Google, type in best investments, and suddenly you're drowning in words like stocks, bonds, ETFs, mutual funds, and crypto. Now this might be confusing, but after this video, you will understand what to do. Think of a company like Apple. It's massive, with buildings, products, patents, and billions in revenue. When you buy stock, you're owning a piece of that business. If the company grows, your slice becomes more valuable. If the company struggles, your slice shrinks in value. Stocks are exciting because they can make you rich fast, but they're also risky because they can crash just as quickly. Remember 2008, when the real estate bubble crashed, and we saw entire accounts being evaporated, or the dot-com bubble that led to widespread bankruptcies? Stockholders felt that pain. On the flip side, stocks historically outperform almost every other investment over the long term. If you had put $1,000 into Amazon in the late 90s, it would be worth hundreds of thousands today. That's why most investors, even cautious ones, keep at least some stocks in their portfolio. If stocks feel a little too wild, what about something steadier? An investment that's basically a loan you give to governments or companies. Imagine your friend asks to borrow $100, promising to pay you back in a year with $5 interest. That's a bond in a nutshell. Except instead of lending money to your friend, you're lending to governments or big companies. When you buy a bond, you're the lender. The borrower agrees to pay you interest on a set schedule and return the full amount when the bond matures. Because of that promise, bonds are generally safer than stocks. They won't make you rich overnight, but they give you a steady, predictable income. For example, US Treasury bonds are considered almost risk-free because, well, the US government rarely defaults. On the other hand, junk bonds from struggling companies pay higher interest, but they come with much higher risk. Government bonds are like a slow, steady cruise. Junk bonds? More like a roller coaster with no seatbelt. If you don't trust yourself and want a professional to manage your investments, we have a solution for that too. Say you don't want to pick individual stocks or bonds. You don't have time to research Tesla's earnings or analyze corporate debt. Enter the mutual fund. Think of a mutual fund like a basket filled with dozens or even hundreds of investments. Instead of betting everything on one horse, you're betting on the whole race. A professional manager decides what goes into the basket, spreads the risk, and you buy a slice of that basket. The advantage? Instant diversification. The downside? You pay fees to the fund manager, and those fees might look tiny, like 1%, but over decades they can eat a massive chunk of your returns. ETFs or exchange-traded funds are the modern version of mutual funds with better features. An ETF is basically a mutual fund that trades on the stock exchange like a single stock. Let's say you buy an ETF that tracks the S&P 500. That means you instantly own tiny pieces of the 500 biggest companies in America. One purchase, and you're diversified across the entire US economy. ETFs are cheap, flexible, and easy to trade. That's why they've exploded in popularity over the last 2 decades. For most beginners, ETFs are often the smartest way to start without feeling overwhelmed. Paper assets are one thing, but what about something you can actually touch, walk into, or even rent out? Who doesn't dream of owning property? Real estate has been the path to wealth for millions. You buy a house or apartment, rent it out, and collect cash every month. Plus, over time, the property itself usually rises in value. But real estate also has its headaches. Tenants can be difficult, maintenance costs pile up, and it's not exactly easy to sell a building overnight if you need quick cash. Everyone loves passive income, until the toilet breaks at midnight. There's also a way to invest in real estate without being a landlord: REITs, or real estate investment trusts. REITs give you real estate exposure without fixing toilets at 2 a.m. What if you don't want any of it? Well, let's go back to basics, stuff that literally keeps the world running. Commodities are the raw stuff the world runs on. Gold, silver, oil, coffee, and wheat. They're physical things you can touch. People invest in them mostly to hedge against inflation or economic chaos. Gold, for example, has been a safe haven for centuries. When everything crashes, gold usually doesn't flinch. Oil and agricultural products, meanwhile, rise and fall depending on global demand, supply shocks, and even politics. But commodities can be insanely volatile. Prices can swing wildly due to weather, wars, or government policy. So while they're useful in small doses, most experts warn against putting too much of your portfolio here. Commodities feel ancient. What about money built for the future? Digital, decentralized, and controversial? Bitcoin, Ethereum, and Dogecoin are words that make some people excited and others roll their eyes. At its core, crypto is digital money built on blockchain technology. No banks, no middlemen. Just a decentralized network. The upside? Potential life-changing gains. Bitcoin turned early believers into millionaires. The downside, however, is extreme volatility. A coin worth $60,000 one year can crash to $20,000 the next. Governments are still figuring out how to regulate it, which adds another layer of uncertainty. It is the digital Wild West, exciting, dangerous, and unpredictable. Some see it as the future of money. Others see it as a bubble waiting to pop. Crypto might feel like chaos, so how do you balance that with something simple, slow, and proven? Here's a little secret. Most professional investors don't actually beat the market long-term. That's why index funds exist. Instead of paying a manager to try to win, index funds just copy a market index like the S&P 500. It's the ultimate lazy genius move. You don't need to research, trade, or stress. You just ride the wave of the overall market. Over time, that wave has consistently gone up. Warren Buffett himself says, "For most people, the best thing to do is to own the S&P 500 index fund." Now we're entering the VIP section. Hedge funds are private pools of money run by elite managers. They can invest in anything: stocks, bonds, real estate, currencies, and use complex strategies like short selling or derivatives. Sounds cool, right? But they're usually only open to wealthy investors. Think millionaires and billionaires. And despite the hype, many hedge funds underperform simpler investments like index funds. These are the Ferraris of finance: expensive, exclusive, but not always effective. Finally, let's talk about private equity and venture capital. These are ways to invest in companies before they go public. Private equity buys existing businesses, improves them, and sells them for a profit. Venture capital, on the other hand, funds startups in the hope that one of them becomes the next Uber or Airbnb. The risks are huge. Most startups fail, but the one that succeeds could pay for them all. For everyday people, access is limited, though crowdfunding platforms are slowly opening the door. Still, this remains a playground mostly for the wealthy. So we've covered stocks, bonds, mutual funds, ETFs, real estate, REITs, commodities, crypto, index funds, hedge funds, private equity, and venture capital. That's a lot. The question is, which one should you choose? Spoiler: there's no one-size-fits-all investment. That's why the best investors don't put all their eggs in one basket. They diversify. A little in stocks for growth, a little in bonds for safety, maybe some real estate, maybe some index funds. The mix depends on your goals, your age, and your risk tolerance. If you're young, you can take more risks because time is on your side. If you're older, you might lean more towards safety. But the key is understanding the menu, knowing what each investment is, what it offers, and what it costs. Because once you know the game, you're no longer the outsider staring at the secret club. You're inside, playing the same game as the wealthy. And here's the fun part: you don't need millions to start. With apps today, you can buy fractions of stocks, ETFs, or even crypto with just a few dollars. You don't need millions to play the game, just the knowledge to start. And the sooner you start, the sooner your money stops being lazy and starts working for you. If this breakdown helped, check out our video on the 10 financial mindset shifts you need to make to become rich. Hit subscribe and let's build wealth together.